Good afternoon, good evening, or good morning, whatever time it is. In this episode or video, realistically, it will be a really long one. There will be a lot of in and outs with a lot of things that I will be teaching, and it's all raw. There is no script, nor is there any type of PowerPoint to do anything. And after all, this is all educational. This is not any financial advice, nor is this something that you should take as actual information to use for other options and things. So today I want to go over every single ICT concept and model that I personally know and how I understand it by. We're going to go over the complete basics. We'll go over Friday, which is today, the 25th of April, and its price action and just understanding what we see here. First, we want to understand what is liquidity. First, liquidity is what? When it comes down to economics and finance, it's money, right? It's money where it can be taken from, it can be rated, or it could be whatever. So, liquidity is some sort of high being placed. What is a high? A high is when there's a 3 candle move. Say, for example, this candle here, and this candle here. If we're just going to be focusing on these 3 candles, what do we see as a high? It comes by the wicks. So this here is not above, nor is it like nearby towards this. A high is when it's actually prominent from a wick. So this will be a high here, meaning this here is not a high. It's not considered a high because this body of a candle has closed above this wick, meaning that this is not a high. This is just a candle doing its own thing. Wow, this is a high because there's no other actual candle close, which is this entire box, black or white, doesn't matter, whatever colors you have, and it's not conflicting this wick. So this makes that a high. This goes the same as a low. So what is a low? Any candle that is not conflicting with its actual body. So this will be considered a low. Why? There is no candle that's interfering with the actual wick itself here. So why would this be a low but not this? Because, well, this wick has overextended upon this wick. And remember, when it comes down to highs and lows in a market, it has to come from a 3 candle formation. It can't just come from one, because if you just have one candle, yes, that will be the high, but you need other candles to confirm it. So this will be a low. This will be a high. Practicing understanding liquidity. This won't count because this body, if this was a 1, 2, 3, this will not be a high because of this body close. So anything that stands out that is shown as a high or low, this is a high from these 3 candles. And if we come to these next 3 candles, because of this most previous, this is also another high. And this doesn't count, none of this counts, but this is also a low. Why? You could tell there's nothing that's conflicting with this. Just like this. This is still considered a low because see how this wick is not conflicting with this one and this 3 candle formation? This, a low, this, a low, this a high, this a high, this is a high, this is a low. And it doesn't matter what candle it looks like, black or white. Even though it looks close enough, those are highs and lows, understanding highs and lows. So that is liquidity, just understanding highs and lows. So the next thing I want to go over is equal to relative lows. What might that be, or what might it look like? It would look like, I had a good example on this here. So an equal low is when you could tell this is a low from a 3-candle formation. 1, 2, 3. I wouldn't consider that equal. Where was the equal? Here, I think. No, I'm a liar. An equal low is just when it's a low that makes the same low without sweeping it. What that means is this here is an equal. This is what equal lows look like. It could be white or black candle, doesn't matter, as long as it doesn't go under. And this counts as wicks too. So if a wick was to make the same wick at the same low, so let's say we had this low here, right? We made a low here, price goes up and price comes back down, and we don't take this. And price just continues to make the same exact low pretty much. We use that to continue higher before we continue lower. I'll go over that shortly. But this also goes in as well as equal highs. They're just equal. Relative to equal is just like a tick away. Pretty much the same thing, relative to equal highs. Like something relative to equal would be this here. This is a low from the 3-candle formation. 1, 2, 3. This is a low. This low is counting enough to the point that it's considered relatively equal. And what does that normally do and show for price? It shows that we're going to come down here one way or the other, but we're going to go up before we go down. That's how markets work. That's how price action works. Let me see if I can find equal high here. Or relative to equal high, like this here. We have a high here from this 3-candle formation. We have another high here. I wouldn't say it's completely equal, but it's relatively equal. It's like a stacked high. What is a stacked high? Pretty much just a lot of highs that are pretty much connected to one another. What does that mean? We make a high, make a low, another. It's not going to look just like this, but let's say we do that. This is a high, your actual high that you want to see price continue, and this is just the stacked high because we're stacking what? Liquidity, meaning we're stacking highs in this financial market. So that is what a relative to equal low is, and that's what liquidity is. So next concept I want to go over will be imbalances in the market. What is that? That means any 3-candle formation that actually has a space without the wicks, which is the wicks is these empty lines here. This is a wick to the downside, this is a wick to the upside. It's small, but like it could be anything just like this. Every candle has its own wick. So this wick here is this line. Here, it's not gonna be even, but it's fine. So these black lines here is considered a wick right here. These wicks are important because it shows that price from here or here, doesn't matter, wherever market wants to open the next candle. This means that price went up to this, but after price went down and actually closed at this. That means price went up. Let's say this is $20 and price went up to $25, but after we close the next candle, it goes back down to $20. And this could be, of course, 15 to 10 to 15. It's pretty much the same thing. So what does that look like? Right here, you could tell this is on the right side. It shows 19,371.5, and then this is the actual open of the candle, because wherever most of the time when it comes to bullish candle, which is the white candles, bullish meaning price wants to move higher, bearish means price wants to move lower. So when it comes down to opening candles, let's say a bullish opening candle, we have this as close. This is open of this candle right here, meaning price comes here as an open. There are 4 stages of a candle. That would be a high, low, open, close when it comes to a candle. So when taking this into consideration, this closes. This closes here. This actual candle right here. So what happens? Price opens here, which is this bottom box right here when it comes to a bullish candle. So this is open. Price does whatever. Say we go down, then comes back up. This is what we make as a low, but we don't actually count this as a liquidity point. It's just a low of this candle itself. And this will be the high of this one particular candle. And the close will be this here. Now, for a bear scenario, it's different due to the fact that once we open up from a bullish or close out from a bullish, we open here, yes, but this will be the open of this new candle. This will be the high, this will be the low, and the close would be down here. Instead of closing up, creating a white candle, meaning bullish, we close to a black candle, which is a bearish candle. So that is the little concept of open, high, low, close. So imbalances, what are they? It is when 3 candle formation, 1, 2, 3, there is a huge gap in this one particular candle right here, where from this high to this low, this is an imbalance. What does this mean? This means market went up too fast, where orders, which means people who are actually trying to take a trade, missed out on this. So what does this normally mean? This normally means that when it comes down to markets doing some sort of manipulation or continuing wherever it wants to lead to, we could see from here that after we took out this high right here, we come back down to what? This fair value gap. And we wicked it. This means we got quote unquote all the orders of all the other traders, and then what happened? We continued higher. So that's important to know. And when it comes to fair value gaps, there is always fair value gaps being made. This is just a bullish one. This is going to be a bullish one here, another one here. It's just 3 candle formations, and you got to make sure there's no wicks in the way. Like, for example, there is no fair value gap right here, even in this 3 candle formation. 1, 2, 3. Because why? The candle closed, but the wicks are above, meaning that there is nothing here. No fair value gap is what we call it, because we want like other people to have quote unquote fair value when it comes to something like this. So see how once we take some sort of high, meaning price of course takes this, then we come back down to what considerably retest this is what this means. We come back to it and we wick it. So that shows fair value gap, and sometimes there are fair value gaps that are extremely small. Like here's another fair value gap. Just understanding fair value gaps and how to spot them is important. Another fair value gap. Let's see if I can find a really small one, like this one here. Like this one's a really small one. Not all fair value gaps are going to get touched, but that's what fair value gaps are for a bullish scenario. For a bearish scenario, you can already tell. Bearish fair value gap, meaning it's a moving to the downside type of fair value gap. This is bearish, bearish, another bearish, another bearish fair value gap, another bearish fair value gap. And see how there's a lot of fair value gaps to the upside or to the downside, and it kind of just looks like it's not really getting respected. It's not, because it's technical analysis how price wants to work. So that is when it comes down to holding a fair value gap, meaning we wick it, right? So how these work is this. When it comes to a fair value gap, we want to see a candle, which is this here, to wick it and to what we call respect it. Meaning that we're on the 15-minute time frame, right? So this is a 15-minute fair value gap. We made this in 45 minutes. One candle is 15 minutes, another candle is 15, and this is 15. So we create this imbalance fair value gap, bearish fair value gap, right? So we see price comes up, and we could tell that, okay, remember, this is a open, high, low, close. So this high went in, right? And it came back down to close, down here. That's black, so you can't see it. But we come to close this here. But this wicks it. What does this mean? This means that when we don't actually close a candle above this, this means that this is getting respected, meaning that we got the orders and what we want to do is what? Continue lower. So if you want to take a short here, meaning price, you're expecting price to go down lower, you can. You can take out the most internal low, which is, remember, 3 candle formation, 1, 2, 3, and no wicks are bothering or interrupting this, so this is an actual low, wick or candle, whatever it is. And you could take a short here. Why? Because this fair value gap is being respected. So fair value gaps are just simply, okay, I missed maybe like, okay, think of this like the highway. This is the road, and you're following the map and the GPS, and you're like, oh, I can't make it, so this is an exit. You come back, and you're like, okay, I made it to the exit. Now I can go to where I want to go. Same analogy, right? You're not trying to go somewhere else. You want to continue going where you want to see price continue. So fair value gap, wick it. Wicks mean that we're holding it. If we actually close it, like for example, let me see if fair value gap that holds. Like this here. See how this is a fair value gap here? I wouldn't really count this, but you can show that this is a bearish fair value gap that you see right here. But why did price continue? This means that this fair value gap has been invalidated, right? What is it? You know, obviously you should understand what invalidated means, but just say it means this doesn't work, right? Remember, everything is a concept here, and you had to combine it all together to make it work. Meaning, this fair value gap got disrespected, meaning we closed it. See how there's no wick? This counts as a wick, but look at this candle. We're holding this, meaning that we don't want to see this be used to continue lower. We want to see this kind of move upwards, wherever the draw of liquidity wants to be. Remember, draw means where does the market want to go to? Okay? So we use imbalances as a way to have orders, any trades or positions, to either continue or to displace. Displacing means that we have a bullish fair value gap here, right? Meaning we displaced with another candle that is opposing to the opposite direction. Meaning this is a bullish candle, right? 1, 2, 3, and there's an imbalance here from this wick, this low of a wick, and this high of a wick. So this imbalance here is like, okay, we missed the orders, so we want to use this to continue higher. Well, what is this? We displaced, meaning that this no longer is valid either, because we closed. If you close inside or outside of the fair value gap, then it won't really work in your favor, because it means that it got disrespected. We want things to respect, just like this here. This is respecting. And what happens? We come to take this high. We wick it, and we come to take out the high. Have a continuation. So I can go back a little bit so that you're not looking at this. Just like this here. 3 candle formation, 1, 2, 3, and sometimes there might not be like a wick at the top. That's perfectly fine as long as there's still this 3 candle formation. So you might think like, okay, so this shouldn't work, right? Well, it does. Why? First off, we didn't close under this. It would be a different story if we closed down here. That means it doesn't work anymore. If we close down here in that rectangle, then we know that it doesn't work. But instead, it closed inside. Closing inside is the same thing as a wick. And we can continue higher, as you can tell. Just like this here. This is like a really small fair value gap. You could tell. Like, from this candle high to this candle low. It still works, but perfectly fine. So that is bullish and bearish, imbalances. This is a bearish imbalance. Now, why do you think price didn't want to respect this even though we candle closed it? Well, remember, this is a concept that works perfectly fine, but what is the draw on liquidity? What does it look like? We're in a what? General uptrend. From here, we're in a general uptrend. So why would you want to take anything yet? So that's why it's important to know that even if you see this work, it won't work if it's going opposite of the market. You don't want to predict the market, you want to see where the market's going. So that's why we closed above it all. So the next thing I want to show you, which is a little more advanced, but it works great depending on, of course, whatever you want to trade and whatever you want to use as a concept. But it is inverse for value gaps. What is that? It is when you see a fair value gap, like you see how this one here, right? It gets displaced through. So now this means that this bullish fair value gap gets what? Disrespected, right? And it gets displaced through, meaning price closed under this. You could tell because it closed down here, right? But this can be used as what we call an inverse fair value gap, meaning we can use this as a way to continue lower. Because, yeah, there's a bearish fair value gap here too, right? So we expect this to hold if we're bearish. So that you can use, or more advanced, like I said, is the inverse fair value gap, where price displays through this and price comes back up into this. We're using this bullish to reverse, meaning normally when it comes to bullish fair value gaps, what do we want to see? We want to see this hold and we continue higher, right? But if we displace through this, meaning, okay, that means market wants to go lower, right? So if we come back up to this, this means this is the same thing as a fair value gap, but it's just inverse, meaning if we're bullish, meaning we wanted to see price go higher with this move here to take this, internal high, what do you think it means to reverse? Meaning we want to see price come back up to this, to use this as leverage to go down. So, have good risk, and we can take out this most recent low. Is this news? It doesn't matter. But this would have been, a way to use this inverse, because we're inversing our bias. Our bias means where we want to see the market move for the day. So that's an inverse for value gap. Here's another example that if I could find one. That was a bullish inverse for value, or bearish inverse for value gap, because it's kind of confusing at first, but once you understand it, it's nice. Let's just zoom in. Like an inverse could be this here. It's a really big imbalance, but this is bearish fair value gap. We come up, and what do? We close this. We close above. You could tell the close is, remember, here, and the fair value gap is here. So we closed above this, meaning that we disrespect this. Now we can use this as an inverse fair value gap. Normally we would use this to what? See price move lower, right? But instead, we get to see price use this as we displace through to come back into it and then continue higher. As you can tell right here, price did whatever. Oh, price did its move using an inverse. Another inverse is, we had an inverse the other day, like this here, a bullish inverse for value gap. How is this inverse? Displacement, we displaced through this, and what happens? Price went back up, candle wick, it doesn't matter if it's above or out, like above or inside, it doesn't matter. As long as you wick it and not actually candle close it, we're respecting it, meaning we could take shorts, meaning we want to expect to see the market come down. Market come down to take the most recent low or continue lower, whatever it's going to be, whatever your bias is into the day. So it's important to understand inverse value gaps, fair value gaps, and liquidity. See, bearish value gap, what are we doing? Candle wicks are holding, meaning we close, and these are just the highs, highs, and highs. We're holding this, and what happens? Price continues lower. And remember, not all fair value gaps are going to work. Like, let's see, like, normally there are some that just never work, because normally those aren't ones that are used for, to work, because when you displace really fast, and like this here, it's small, but this fair value gap here, normally you would use this as an inverse, and you kind of could, but you didn't really take any lows or anything. But you would never expect price to come in here and to respect it. It's rare for that to happen. You would normally want to see it in a area where price is most likely to come down to. Like, it's not often that it would work. Like, see how there's there's a fair value gap here, a fair value gap here, a fair value gap here. Well, we could tell this is an inverse, but why would you want to take anything to go lower when the market is an overall uptrend? You know what I mean? You don't want to take any reversals, because you need more, structure, more of candles to show you where it wants to go. So we could tell there's 1, 2, and 3. See how this one didn't work? We displaced. See how this one didn't work? We displaced, but this one did. When it comes down to a lot of these candles making fair value gaps, the next concept I want to go over is what we call premium and discount. What is that? Well, when we're in a range, what is a range? It's just a lot of candles with a low and a high that can be used inside of a box, which is, you could tell this box here, this itself is a range inside of another range, but I'll go over that sooner or later. So up here, when we want to take like longs, premium is when price is too expensive. We're like, okay, we don't want to, take anything up here because it's too expensive. So we want to see price move lower. This is discount. In a bullish scenario, or when you expect price to move higher, you don't want to take any longs up here. You want to expect price to come back down here to any imbalance or wherever price wants to respect down here, then to move higher. Because, like, say you want to buy something for $5, right? But a sale is going on for 10%. But you know that in the next few days, Black Friday is coming up. So why would you want to buy anything here when you could just wait for price to come back down here, or Black Friday, and then you could buy it? You buy here, you continue higher. That is premium and discount. It's just understanding that anything above the 0.5, this is what we call like the middleman, the equilibrium, I guess, to both of these sides. You want to take anything down here for longs, because it will give you the best risk to reward, and it will make it so that you can understand that price can actually use this area as a confluence, a fair value gap, for example, to move higher. Confluences are just like anything. a high, this is a high, this is a low, this is a fair value gap, right? A confluence is just a concept that adds more probability to your trades. Every trade that you take is probability based. So you got to understand that. So let's go for a bear scenario here. We didn't really have any bearish days recently. Like, for example, this high to this low here. When we want to see price go lower, why would you want to take this fair value gap in here when you could take the one up here? Or the inverse, whatever it wants to be. Same thing. They work just as well. Normally I like seeing inverses work more. Just realize how this is actually the premium because it's flipped. Why? Because we don't expect price to go higher in here. When we want to see price move down, everything's flipped. This is a discount. This is the premium. This means any confluence down here, you don't want to take any shorts down here. You want to see price at least come up to the premium before what? We move lower. That is a bear scenario of premium and discount. So it's important to understand that. The next thing I want to talk to you about is liquidity sweeps. 1 hour. Okay. What is a liquidity sweep? It's kind of just the same thing you expect. When it comes down to liquidity sweeps, we want to use it as a way to understand that price is already taken. Meaning, when we want to move or reverse, meaning we go in a different way in the direction of the market, this means that a low, you can tell this is a low because 1, 2, 3 candle move, no wicks are counterfering with this actual long wick here at the close. So this is what we consider a low. What is a liquidity sweep? Means price completely took this out. This could be a wick, this could be a candle close, whatever it is. This means we did what? Liquidity sweep means we swept this liquidity. Now what do we expect to do? When it comes to liquidity sweeps, we either want to see either we continue to like wherever way the market wants to move, or we reverse. So you could tell that, well, the market kind of went down, right? In this area here, it looks like we're in a downtrend because you can tell. How do you know you're in a downtrend? Just in case you don't know. This is a high, and we make a lower high. And the next, lower low, lower high, lower low, lower high, lower low, lower high, higher low, higher high, higher low, lower high, lower low, higher high, and then another higher high. You know, it's, you can just tell from the direction from, if you look at from outside, you can tell we're moving down. So normally we expect price to continue moving down, right? No. When we take some sort of liquidity, this means that we expect price to move the other side. So that's why when you like look at other guides and stuff like that, people will probably say you want price to move lower to move higher, or vice versa. You want price to move higher to move lower. So what do? We wanted to move higher, so we need the price to do what? Move lower. So that's what we did. Liquidity sweep. Right? We can tell. What is this? A fair value gap. When you make like one like this and it actually holds, that's perfectly fine. And what is this as well? This is also an inverse. And what do? Candle close above wick. Same thing here. Hold this. What else here? Boom. Lots and lots of fair value gaps. And look at that, we're holding that. So what do? We moved higher. Lots and lots higher. So a liquidity sweep can be the smallest thing known to man. So this here. This, we swept this with this candle here from the wick. And then remember, this is also a low. Because remember, 3 candles, no interfering wicks or candles, and boom, we swept this too. So those are just liquidity sweeps. When you hear people say external liquidity sweep or internal liquidity sweep, what that means is in here, inside of this, we did what? We internally swept this liquidity. Externally is something like this. From this low, that's an external sweep. Next low here, boom, sweep. And then another sweep. Will that be interfering? Nope. And this is a equal low. So we'll expect price to come down here whenever it wants to come down here, but you can tell we're overall uptrend. So that explains liquidity sweeps for you. So the next thing I want to go over is a more advanced concept that I use. I don't normally use things like break a structure, like this is considered a break a structure here. From any high that we close, this is a break a structure, or any low, this is a break a structure. Break a structure. Well, actually, no, that's not a break a structure, but that's a liquidity sweep. And see how we moved higher before we can do what? Move lower. That's liquidity for you. So you can, if you want to go over break a structure, I will not be going over that. I'll be going over what I use, which is what I call the change in the state of delivery. What does that mean? So it comes from a series of up closed or down closed candles. So you could tell, let me just zoom out. I'll go on the 15-minute. So I need to catch a reversal. So here. Well, okay, so in here, what do we see? First, mark out what we actually see. There's a fair value gap right here that's getting held, right? We wick this. What happens? We swept liquidity in here, right? So this is its own range, meaning this is the high that I want to see price continue to once we, go lower before going higher. So in this range here, kind of looks like just like consolidation, meaning price is not really moving anywhere. We don't really have too fast of movement. So here we see this hold, and a change in the state of delivery is this: a series of any sort of candle. See how this is 2 candles? It has to be a series. This is considered a series. What is a change in state? From the time we closed, and this is bearish candles. And if we want to see price move higher, a change in state is when we close and there is another candle that displaces through. This is a change in state. This means that, well, okay, I know that price was bearish, but if we close above this part here, the change in the state of delivery, this means that price is wanting to deliver higher. And the state of it originally was bearish until we closed this candle here to move higher. So I'll show that in action. This is on a 15-minute. So even though it doesn't look like much here, it's always showing. Like this is 1 candle, so it won't count, but you could tell, okay, what is this? 2 candles? What is this? A change in the state of delivery. What is this? A change in the state of delivery. Even though there's like a wick in the way, it's perfectly fine as long as there is a candle that's closing. If it doesn't close, it's not gonna count. It's not gonna count, excuse me. Like this is also a change in state of delivery, but on a bearish scenario. But why did this work? Remember, because overall we want to see price do what? Go higher. And remember what we talked about? Liquidity. What is this? This is that high that we want to see price, try to take out. And this is stacked. Why? High, a high, a high. Here. A high, a high, high, a high, a high. Oh. Okay. A high and a high. So we will want to see price come and take this out. What this is also known as, before I continue to change the state of delivery, is low resistance. What that means is, most likely when price is to do its thing, this means, I don't have that anymore, but it's when there's a lot of stacked highs here, and low resistance means we're going to go take that extremely fast. And you could tell in the span of, from the time we had the change in state here, you could take an entry here at 8:25. We took the whole entire thing out at 8:50. In 25 minutes, we just that fast. So Changing the states are just simply candles, series of candles, closing on its actual original close. See how this one doesn't work? We would use this as a way to continue higher, but it's not actually a change in state delivery. Why? Because there's wicks here, so it's not going to count. It has to close, no matter what. Like this here, we closed, so we continue lower. And this here, this is a change in state. It's important to understand changes in states of deliveries, but you're not going to use all of them all the time. It's just mostly for entries and stuff like that. The reason why you wouldn't want to take this is because, remember, this fair value gap is not going to hold, most likely, because we normally want to see the next ones hold, which is from the high and to the low, from here to here. You could take anything down here, but for better risk, you could wait for price to come down here, or you could take it at the very edge of this fair value gap here. However you like to trade. But that is simply low resistance liquidity that I taught you. That is a bullish scenario. A bear scenario is the same thing, like down here, but it has to trade with the overall draw of liquidity. So the next thing I want to teach you is understanding manipulation. What is manipulation? Manipulation is it could be a sweep liquidity, or something I will be introducing is an SMT, smart money technique. What is that? Let's see if I can show you here. So these are indexes, right? These are sales for indexes, right? This is ES, this is NQ. This is mostly used for futures and some other stuff too, but I mainly focus on trading on futures. Where are we at? Oh, I think we're up here. No? Oh no, we're not. Oh. Perfect. So zooming in. I know we had an SMT over here. Okay. SMTs are kind of hard to understand once you can actually understand how markets work. Here? Yeah. Okay. So what's an SMT? It is a divergence between the markets. So see how on ES we have a low here, right? And we also have a low here. These get swept. This low here from this 3-candle range has this wick here. What is an SMT? An SMT is when we have a divergence, like I said, meaning price is not correlated. See how on NQ this candle here at 10:30 is the same thing here, but how you see this is swept, but this isn't? This means we made a divergence in the market, meaning this is an SMT. This is a technique that smart money uses to manipulate. Manipulating is just simply saying, all right, anyone who wants to, take any type of longs or shorts, we're going to manipulate them. Meaning, we don't want them in here anymore. We want to make our move and just continue forward. So SMTs are mainly used for like saying, okay, this is the last move I'm going to make before I want to move higher. So that's what we did today. This is just... And when it comes to running this BSL and SSL, it's just simply saying sell side liquidity, buy side liquidity, meaning this is buy side, this is meaning this is for longs. So we expect this liquidity, the buy side liquidity, when you buy, you expect this price to come up. So that's why we call this BSL. And the next one, SSL, is just vice versa. If you expect price to move lower, that is the sell side, meaning you're selling to continue lower. So, smart money technique. Let me just do this. And it doesn't have to be from this low either, as long as there's an actual divergence that you could tell. And there was another SMT here too. How can you tell? Well, see how this one at 645 on ES is not swept with this one, but this one is on NQ. Liquidity sweep, meaning we swept this liquidity, and we create SMTs here. Oh, create SMTs here at this 9 a.m. to 6:45 a.m. candle. That is an SMT, a bullish SMT. We use this as a way to show that, okay, well, this is the final move that the big players want to make before we do what? We move higher. This is another confluence that will enhance your trading to the next step, because it's, it's hard to identify because not a lot of people see it, but divergences like that really show that it's just the last thing that price is going to do. And there are times where, SMCs will become invalidated, like this here. There's one at 9:30, 9:30 here, right? And one at 10 o'clock. What we call this SMT is an invalid SMT. Why? Because one, we did come down here, but we need to remember, we need to move lower before we can move higher. So we swept this liquidity here, and we swept it again. This is considered a manipulation as well, sweeping a internal liquidity as a way to form a manipulate. You don't always have to use SMTs as a manipulation. Manipulation can come into many different forms, but most of the time what we want to see when it comes to really good setups is an SMT or a liquidity sweep, or both. Like this one here, this is a great way to show manipulation. We had an SMT, we had this little external range get like screwed over, as well as, what is this on the side here? Fair value gap. So if we see this fair value gap get respected, or price getting held, we could tell that, okay, well, one, candle wick close is up here. We had this liquidity sweep like externally in this model itself on all these candles. And what happened? We swept this internally, a form of manipulation, and we had SMT, so another form of manipulation, saying, okay, well, we're ready to go up whenever you are. So that can show that this SMT here is invalid, because higher on a higher time frame, and from back from this previous data, why would you want to see this work when this is getting held and overall we're what? Bullish, meaning price continuing to go up. So there's no reason to take anything to go lower. So that's why this makes this SMT here is invalidated. It's no longer an actual SMT that's going to work. And you could tell from how we just continued higher. So that's SMTs, a bullish and bearish example. It doesn't matter where the SMT is found, as long as it holds and that it's going in the general direction of the draw of the liquidity. So the next thing I want to go over is order flow. What is that? Go into 5 minutes here. So when it comes to being 9:30 in the morning, that is New York Stock Exchange open, meaning that price is going to most likely make a move, right? Today was not a great move, but 9:30 here, you could tell that out of most of these candles, excluding the times where like there are news, like 9:30 here, we moved. The next one will be here. That's PM. Oh, what is 9 o'clock? down here. And sometimes this is the 930 candle here. And sometimes the 930 candle can be a little weird because what can the 930 candle do is it can either make the overall trend continue, or we can use it as a way to manipulate, meaning we come in to take a liquidity sweep and then move lower. Like this here. Like this is the 935, but this is probably from news here. But this is the 930 candle, right? What do we do overall? Well, you can tell that this has been bullish, right? But there's probably an imbalance over here, and there was SMCs here. I didn't remember that, but 930, we did what? We continued, and we swept this. Swept. And you might be like, well, where would I want to take like a short or whatever? Because there's probably like a higher time frame imbalance in here. Oh, I don't remember where I marked it. Oh, here. Is there? Inverse. You could tell it's getting held. So you expect price to hold it. Now you could tell that, you could see this getting held, but it gets displaced through afterwards. Why? When something gets respected too much, it's just gonna go right through. No matter like how much you see this, it won't ever always hold. As well as you would never want to rely on something that get held that much. We have one candle, two, a lot more here, here, and here. So when we actually have a confirmation of this getting closed below, then we would expect price to do some sort of manipulation, right? Which is this sweep of liquidity here, which is perfectly great. So that could have been a great short entry. So, and sometimes for me, I don't normally like using discount and premium, but you know, you can still use it. Inverse for value gap in here, which is perfectly fine, or what? Bearish for value gap there, whatever floats your boat, whatever you like to use for your strategy. So that is the understanding of manipulation, S&T, sweep liquidity, inverse for value gap, a fair value gap, changes data delivery. So let's go ahead and plug all that in to show that there's an entry model. But before I do that, you need to understand the 4 reasons why market moves. One is to hunt liquidity. Oh, I can't type. Another one is to rebalance to inefficiencies. 3 is to rebalance to equilibrium. And lastly, 4 is to generate liquidity. There is always a reason why market moves, right? So, like, for example, let's go on a higher time frame here. So, first off, this, you know, is the high that we want to see prices move to. Now, you see this here? Even if there's a huge gap, it doesn't matter as long as we have this here of a high and of a low. We still create that fair value gap. So after we set this high, right? We set this high on a much higher time frame. What do we do? Well, what did we do from this whole entire thing here? One, we hunted liquidity. What do we do now? We rebalance. What does that mean? We come back to something to either continue or to go lower or go higher, vice versa, it doesn't matter. So we hunted liquidity, which is this liquidity here. We rebalance to inefficiencies, meaning we come back to a fair value gap, which is an inefficiency. And what do we do to continue? We hunt liquidity. Another thing is from this low, even though, you know, I don't have to always zoom in, you can already tell it's a low once you get good at it. From here, oh, well, actually, not even that. I would have to do it from the, I can't do the same thing there. So like, okay, for me, this is an equal high. So most of the time, or it's like a liquidity sweep, but it looks like an equal high from here. So it's a relative to equal high. Most of the time, we would go lower. So after we do that, what do we do? Well, if we go to a higher time frame, of course. Hello? Okay. Higher time frame. There is okay. Here, fair value gap here, right? This is an imbalance. 15-minute. I hate why TradingView does that. Okay, so we have that. Okay, we see there's an imbalance here. Like, okay, that's cool. As well as when we come here, this comes down to this half point here is the equilibrium. So, okay, we see, okay, price swept this, that's cool. So, what do we do? Well, we just hunted liquidity, so we had to do one of these three things. We rebalance to what? At equilibrium, come back to continue lower, to rebalance to inefficiencies, come back up to equilibrium, and what do we do now? Number 4, generate liquidity. What are we doing? Generating. We're just kind of moving slow. This is 15 minutes, mind you. Moving slow. Draw it this low. Draw it this high. What did we do first? Well, we were generating all this liquidity. This candles. Boom, 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 boom. What do we make here? A low resistance liquidity run. Meaning, price is most likely going to take this out once we move higher. Why as we move higher? Oh, this is also another proof as well for something that you can also take into consideration. 930 open right here. This is what? Manipulation. This is also a fair value gap that's being held. So we come back into this. I actually took this trade, I think. And so price comes up in here. We manipulate 930. We opened the New York Stock Exchange. We come up higher. We manipulate it, as well as we're holding what? A bearish fair value gap. And what happened? We moved lower. And even if there's like a gap like this, it's fine. It's just, it's not suggested that you should be holding anything like this. But this would have been a great trade. Absolutely great trade. Because we manipulated, which is in here. And there's, like, if you zoom in, there's definitely a, I don't think I can zoom in that far. I lied. Yes, I can. And we made this high. We swept this initial high. We're holding this 15-minute fair value gap. 930. We continued higher. We made a high. We come back. And boom. Right here. We swept this. This is the manipulation that we're looking for. And then we continue lower. What else do you see? A change in state of delivery. This is also showing you like, okay, well, price wants to move lower. So price moves lower. And then the price just continues to move lower. As well as what we see here is on a higher time frame, a high and a low. A low and a high. And it's kind of just a lot of candles in here, right? This is what we consider a range. We got out of this range to go lower, which is absolutely amazing to understand, because there's always going to be a range like this here. This is a range within itself. We take out this high, low resistance liquidity run, boom, sell off. Same thing in here. This is another range. What do? A low that's prominent, a high that's prominent. So we want to see price either take one of these out to move the other way or just continue. So we come down here, generate liquidity, generate. Boom. We opened. We took this. We took the high up here, and we took the internal high. That's the manipulation you need to see. And we had to change the state of delivery. Boom. Price is not the best at this time, but price still went down. Absolutely great trade. So it's very important to understand that. So there is the reasons why the market moves. There's always a reason. So the next thing I want to go over is a model called the market maker buy and sell model. What is that, you may ask? Just think of your regular confluences. So let's zoom out. We have what this is here, a 1 hour for value gap, as well as what do we see? A liquidity sweep, right? So simply, it's kind of just the same thing you already would understand. See all this liquidity up here? This is your external buy side liquidity, where you expect price to go in a later date. But there's an internal model, right? You can consider this as a range as well, actually. This range here, what do? We take this out and continue higher. So a market maker sell and market maker buy model is this. So understand generated liquidity. What is generated liquidity? Any lows that are like made. Look at this on a 15-minute, low, 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 and I'll mark it out for you too. Lows. These are all lows, right? So this is what we're doing. We're generating liquidity. Now, we just place through this, right? Internal sweep, changing the state of delivery because we closed this. So we're going to be bearish, which is perfectly fine. So all this generated liquidity is what we call this, or engineered liquidity. What you can do with this is there is a curve. How? We swept all this inside its range, making this the sell side of the curve, meaning there is a lot of sell side. This means this makes what we know as low resistance liquidity, right? Lots and lots of it, and it's stacked too. Like boom, you can see there's lows that are prominent. So we took it out with this model called the market maker sell model, meaning this whole sell-off, we did what? We took out every single low. Every single one of it. Look at that. That is the sell side of the curve, right? It's just taking out all this engineered liquidity. And there's a lot of reaccumulations too, meaning when price wants to go back to an imbalance to continue lower, whichever it is, like there's an imbalance here. It's not really, clear, but it's an imbalance. You can see price used to hold, as well as here an imbalance that we're holding. Lots of imbalances, right? So that is a market maker sell model down here, and it's just vice versa for a market maker buy model. There's a fair value gap in here. I'm just gonna do it whatever. So this is the external, and this is the internal model, right? What is this? It's just simply the same thing. A high, a high, a high, a high, a high, and a high. And a lot more other highs. But this is the buy side of the curve now. We took out all this, and what do? Price expanded to the upside. Oh, price expanded to the upside. Market maker sell model, which is just simply taking all this out. We manipulated, which is we just took this external low. There's probably an internal sweep in there. And then there's engineered liquidity here, and also known as low resistance liquidity run, meaning we expect price to move all the way up, taking all this out. And what do? We do that exactly. That is a market maker buy, market maker sell model. And it doesn't occur all the time, but you can see it when you see it. Fair value gap here. What is this? Boom, external sweep, internal sweep, generated liquidity, generated liquidity, generated liquidity, generated liquidity, liquidity, generated liquidity, generated liquidity. And there's not going to always be a sell side after the fact, but there's always one of these models that you can see, which is, you can tell right here. We swept all this out really quickly. Even though today was really slow, we still took it all out. And so that is one of the models that you can use. I use it from time to time, like this here, and it's always occurring on every time frame too. Like, look at all this generated. You could just picture it, but I'll like write it all out, of course. I, 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 and this is just, let me like zoom out. Now this is like a really big fair value gap. Sometimes these work, sometimes these don't, but you know, that's fine. Most of the time when it comes to candles like this, I don't really look for that. I mean, you could technically say you're holding this 1 hour inverse, but that's perfectly fine. Kind of ish, like not really, but that's fine. That's just ignoring the fact more confluences are better. But you can tell there's all this engineered liquidity, all this buy side liquidity that we want to, that is like resting, and we want to take it out. So that is the buy side of the curve that we're looking for now. Boom. And you caught the reversal too. And this range, remember, we made this whatever. Like, see? Everything is just in its own particular range. We took this high out, but we had these equal highs, which, you know, relative to equal, but not really. But this is a model that you can see on the higher time frame. You can always see these models everywhere, but I always use it as a way to say that it's a way to help you understand the draw, because as an ICT trader, it's just a model within a model. What does that mean? You see this here? This is on the 15 minute. Let me zoom in. Whoa, what is this? It's the same model, but what is this? Oh, is this another market maker buy model here? Do we take this low too? We made equal lows. Perfectly fine. We use this as a way to be like, okay, well, what else do you see here? Change the state of delivery. Like I said, as long as there's a candle that closes, it doesn't matter if there's wicks in the way. So that's perfectly fine. As well as we're also holding this 5 minute, as well as price is just moving up. And if you were to actually zoom in, I don't think I could zoom in that far. Probably not. No surprise if I can't. Yes, I can. So you can always find these models within these models. So that was the 5 minute change of state. But if you realistically, if you're here, like equal lows, this is the change of state. It's the most recent series of down close or up close candles. This is a change of state. You could take that, or you could just wait until price either comes down here, which it doesn't always happen, but there's fair value up here. You're holding that. You could take an entry here, or you could just wait for the 5 minute change of state and price comes to wherever, or you can wait for an actual reaccumulation, which is like this here. And we closed above, and that would have been your entry. And remember, that was on this is a 15 minute setup here. You could tell. Oh, I don't think I can go back that far. Doesn't matter. So this is a 15 minute setup, right? And we could tell there was one on the what? The 5 minute. There was a 5 minute setup right here. Inside of a 15 minute setup here. Zoom into the 3 minute, there's probably another setup in here too. It doesn't matter what time frame you're on, you can always do it. Because its price is fractal, meaning you can find it on every single time frame. And this doesn't have to be just on the 15 minute either. You can say that you can find this on the 4 hour. It's a little, and the 1 hour. Look at this. High. 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 It's just really sloppy. Yeah, but a high. This is a 1 hour setup. 15 minute. What's this in here? Another market maker buy model. can also be a sell model too, because this generated liquidity here. You can always find this everywhere. So that's very, very nice to know, as long as you know that price is fractal. So the next thing I want to go over is understanding aligning the time frames properly. A lot of ICT traders don't often do this, but it's nice to know. So we can tell that, okay, well, just from this here, right? We took this high, so we expect price to kind of move lower, but at the same time, not really, because, like, what is the overall trend? Much higher. And on even a higher time frame, what's the draw looking like? Well, we're kind of moving higher. And there's a high up here that we want to take. And there's a 4-hour fair value gap that's being held. So, overall, you should be bearish. Or, I apologize, bullish. I was bearish today, so that's probably what made me think that. But no. So, you could tell that we took this high. So you're like, oh, actually no, I just made a perfect example. So this is a 4-hour, right? This is candle wick day, so we're respecting this 4-hour. So we zoom in. So we should take something that is a long. You shouldn't be taking any shorts. I made that mistake today, but that's ignoring that fact. So this is that manipulation at 9 o'clock. This is before market open, 9:30, and price just moved the way it wants to move. But even if it's news or any sort of thing that doesn't involve like tariffs or anything like that, price is most likely like 80% of the time going to draw towards where it wants to draw in the higher time frame. So if you want to take shorts, you shouldn't be taking shorts, because where are we looking like on the higher time frame? Like 4-hour. Well, we're holding this bullish, so why would we want to be bearish? Even though we just swept this liquidity, like, yes, that makes sense. But we're looking at what the now is telling us, not what the past is telling us. Because like, you might be like, why doesn't this fair value gap work? And it worked in the past. Well, yeah, it might have worked in the past, but what is price telling us right now? Well, we're bullish. And overall, price is moving up. So why would I have to worry about, trying to take a short? So, and you can tell from this here, like, when I just gone over the range with you guys, and well, I expect price to come down much lower. Because remember, price needs to move higher before moving lower, but you got to see first though, because even if you see all this, like, we have this actual range itself, and you can tell if price wants to move higher or lower. So it's just whatever. Normally price would rebalance, but price action is not always the best. So knowing that fact, we zoom into the 15-minute, and this is a 4-hour. So we're holding this 4-hour, meaning higher time frame means that it's higher power. What does that mean? If we see a 1-hour hold, we should zoom in so that we could take a trade in the day to the same bias, just like this here. This is a high. This is a 15-minute fair value gap that we're getting held, or that is getting held. And so I should look for some sort of longs in here. So 5-minute, what happens? Boom. Wow, look, sweep liquidity. Zoom into the 1-minute. I like personally trading on all the time frames. But yeah, boom. Take this. What is this? Whoa, wow. Series of down close candles. What is this? Boom. Change of state. What happens? What did price do in a 4-hour? Oh. We come back to the fair value gap. So what does this mean? I should be trading longs. Price just went up. Continued. That's exactly what I wanted to see. Of course, I didn't take this because I was off for the day. But even though it takes some time, it's not always going to be that's awful. It's not going to always be the best. Price action on Fridays nor Mondays. So yeah, that would have been a perfect entry. And aligning your time frames is very important, because as long as you can align them properly, you can definitely make it to where you want to make it. And this can come down to inverses too. Like, this is not inverse, but I'm just showing you. this is a 15 minutes, so I assume it's a 5 minute after the fact, and I should be taking longs. This is not market open. This is like throughout the day. So okay, I see this change sweep liquidity, sorry, and this is a little market buy model. You could take a entry back once price comes back down in here in the 15 minute, or you could take it on this 1 minute for bag up. And this is internal sweep, so this just gives more conviction. Conviction is just confidence in your trades, and boom. That's your long. So that is understanding aligning time frames. When you see something on the 4 hour, zoom in, because you're a day trader. You're not a swing trader or position trader. Unless you are, then you would always want to be using something like the weekly or the monthly. And you could just tell, like, what is what? Fair value gap. Cool. There's probably not SMTs there. So like, we're holding this on a weekly. Mind you, this is a weekly, so it's much higher power. But you need to understand that when it comes to aligning your time frames, you can't be trading a weekly like imbalance in a 15 minute. It doesn't make any sense. If you want to trade something, you need to learn how to properly align. For me, when it comes to like trading the 15 minute, 5 minute, 1 minute, most of the time I trade 5 minute, 1 minute. I want to see 1 hour to 4 hour holds of something. So see this here, we hold this, zooming into the 1 hour, see whatever it needs to hold, then I zoom in. Then I see what's internal, what's inside telling me that price is doing what it wants to do. And that's how I trade. But you gotta understand when markets are probable. Every trade is not a gamble, every trade is just probability based. So it might sound like a form of gambling, but it's not. So that's aligning your time frames with one another. So let's see, what else is there that I need to go over? There's some other things you can go over too, but I'm just gonna go over what I personally like to use. And then the last thing I will go over is the Forever model by Justin Warline. Credits to him. So, for example, can I find out a 5 minute? I don't remember if there was one. Okay, we can use this as an example. That's fine. Not really, actually. I lied. The Forever model is literally life changing, for me at the least. Yeah, this works. So, okay, we see this fair value gap getting held, right? That's cool and all, but what the Forever model consists of is an inverse fair value gap, which we've gone over, and this is getting held. Internal manipulation, which is some sort of super liquidity. An SMT, it's optional, but it gives you much more conviction. And zooming in, lastly, because I can't find the 5 minute, is a change in the state of delivery. The Forever model. Boom. Nope, I lied. Change of state. So that's change of state. Internal super liquidity. Most of the time it also works with external super liquidity too. And an SMT internally. And as long as it's going with the bias of the market, it's amazing. Like, this is just the 1 minute hold, but you can see much higher returns with this. And this is just a 1 minute. Of course, if you find this on a 15 minute, you can find it on a 1 minute, and it plays out perfectly. All it consists of is just an inverse fair value gap, a change in state of delivery, an SMT, and some sort of sweep liquidity. And your risk to reward will always be the best, as long as you're a good risk management trader. For me, if I were to take this, I would put this at the protective loss, and I would probably take full profits here. A 1 to pretty much 5. and let's say price takes out this first high here. For me, I would move my stop to break even, and I would have probably partials. But because I'm so bullish, if I were to take this trade, because I'm so bullish, I wouldn't be taking any partials. I would just wait for price to just skyrocket. And this happens on every single time frame too. As well as, there's different models you could trade, but I mainly just trade one, but I should start trading two. But ignoring that fact, that is pretty much everything that I know about ICT trading. There are other things like, actually, we can go over this. The AMD model, which is a good model, if you understand it. I normally don't trade it, but it's nice to know. So I will count this, right? Yes. Okay. So it's when price is really slow, right? This is really slow pricing. So it's just simply when price is just moving really slow, there's a lot of liquidity, and let's say this here. This is the accumulation, and we had that final manipulation, which we talked about, internal super liquidity, to show you that, okay, well, price is going to do its thing. And then lastly, this is the manipulation, and then this is a distribution, right? AMD, accumulation, we're accumulating, meaning slow, like complete, like really bad price action, doing whatever. We manipulate the final move before we expand to the upside. The AMD model. It's great. But you can find it for, that's a bullish example. I'm gonna see if I can find a bearish example here. Normally we haven't been getting AMD models that often, but it's not like improbable. Like this here. We accumulate, just chop, final move of manipulation, and then what? We displace. We displace. AMD. Accumulation, manipulation, distribution. That's absolutely great to know. Another thing is that's the AMD model. Another thing is the seek and destroy model. This I don't use this indicator as like something like this, like, oh, this is like perfect, I should take this. No, it's just simply for me to understand and for me to see, because like I don't like looking at candles all the time and be like, oh, so this New York low, this is London low, this is London high, Asia low, Asia high, whatever it is. I like using this as a way to see what times each candle made by the time that it moved. So simply an AMD model, or not an AMD model, I apologize. A seek and destroy model is just simply Asia session, bullish, Asia session, London session, and okay, where are we at? Okay. Boom. Okay, so simply what it is just Asia session making the low of that time session, and then London session to take out the Asia low and the Asia high, and then New York simply doing the same thing but just for London. So all it is just simply, okay, whatever happens in Asia, we want London to sweep both. And what happens in London, I want New York to sweep both. So that's simply what seek and destroy is. A seek and destroy model. You can tell here. The reason it doesn't show like a bit of all this for New York is it's an indicator. It doesn't really matter. But in technical terms, this sweep here is what I consider it. So Asia high, Asia low, what happens? Well, London takes out this Asia high and comes down to take out Asia low, and then simply the same thing with New York open. Price comes up, we take out London high, and then we continue lower. I don't like looking these at potentials because I don't I don't use indicators to trade. So that's what I think regarding about indicators. If it works for you, it works for you, but not for me. Like this is a perfect example. Asia session, high, low. London sweeps this. Asia high sweeps Asia low, and New York sweeps London high, sweeps London low. That is a seek and destroy model. So it's nice to understand seek and destroy, but as well as it's also a way for you to use this as a way to see where draw wants to be. So, and this one is just power 3. Power 3 is also known as the AMD model too, but that indicator is just the 4-hour candle and where it wants to be headed, and you could just trade it regularly intraday and see if candle closes lower or higher. It doesn't matter. I don't use it. I just have it there. So that's mainly everything that I have for this kind of long educational concept video. So just understanding that and going over that, you can definitely make a strategy out of it. It's very nice to know. Like I said, there's other things that I could have gone over too. It's just I don't because I don't use it. I don't really use it like that, but I guess I could go over something like or block or breaker. There's also like unicorns, weekly profile, stuff like that. So I taught you what I know and how I see the market, and I don't look for other much things except of my setup. So that is mainly it. And so I will see you guys in the next one. Peace.